If you have ever wondered why the put costs more than the calls, or why options at the different strike prices don't have all the same implied volatility, that's a skew at work. Hey traders, welcome back to the Quant Academy. My name is Frank Sarjurian, and today we are diving into one of the concepts that might sound a bit technical at first, but it is crucial for anyone trading options: volatility skew. And understanding the volatility skew can give you the powerful edge when it comes to the pricing options accurately, choosing the right strike, and even constructing the spreads. So, whether you are just starting out or looking to sharpen your edge, this video is for you. Now let's unpack the volatility skew together. Let's start simple. The volatility skew refers to the difference in the implied volatility between the options and the different strike prices, even if they have the same expiration. In an ideal world, options pricing models assume volatility is the same across all strikes. But in the real world, not even close. In equity options, out-of-the-money puts often have higher IV than the out-of-the-money calls. It isn't random, it's demand-driven. Investors often buy puts for protection, pushing their prices and implied volatility higher. This uneven distribution of the IV across a strike is what we call skew. Why does a skew exist? So, why does a skew happen? It boils down to the supply and demand and the bid of the fear. In the stocks, investors are generally more worried about downside risk. They are willing to pay up for the puts to protect their portfolios from crashes. This increases IV for puts relative to calls. In other markets like commodities, you might see the opposite. SQ can lean towards the calls if there is a more risk or shortage or supply shocks. The key point is that SQ reflects market sentiment. If put IV is elevated, the market is pricing in the more risk to the downside. Now let's talk about the types of skew you might encounter. First, forward skew or positive skew. IV increases as the strike price rises, common in the commodities where the supply shocks can drive the price up. The second is reverse skew or negative skew. IV increase as the strike price fall, typically in the equities where downside risk leads to the higher demand for puts. And the third one is smile skew. IV is higher for both out-of-the-money calls and puts than for at-the-money options. Happens in some markets like FX, where the large moves in either direction are possible. In equities, reversal skew is the most common, higher IV for lower strike puts. Now you might ask, how does the skew impact your trades? Well, if you are buying the options without knowing the skew, you might overpay, especially for out-of-the-money puts. Let's say you want to buy a protected puts far below the stock's current price. If the IV skew is steep, that put might be much pricier than expected. Same for selling options. If you sell a put spread, you are selling the high IV options and buying the low IV options. The skew can work in your favor or against you, depending on the strikes. The key point to it is that skew can inflate or deflate the premiums, depends on where you position yourself. How can you use the skew to your advantage? First, choose better strikes. If skew is steep, you might consider buying the closer to the money options and selling the farther out of the money options to capitalize on the inflated premiums. For example, in the bear call spread, you might sell a call with higher IV and buy a call with a lower IV, improving your edge. Second, constructing spreads. Strategies like vertical spread, ratio spreads, or iron condors can exploit skew. Selling the high IV options and buying the low IV options helps capture the premium differential. Third, reading the market sentiment. A steep put skew signals fear in the market. Shallow or flat skews might indicate the complacency. Adjust your risk accordingly. Maybe hedge more if the skew is elevated. And the last one, event trading. Around events like earnings or Fed announcement, skew can shift. Watch how the IV curve moves. It can help guide your strike selection. Okay, let's wrap it up with some pro tips. First, always check the skew curve before placing multi-leg trades. Most platforms plot IV against strikes, so use it. Second, in the bear markets, skew tends to steepen as downside fear increases. In bull markets, skew may flatten. Third, combine the skew analysis with the IV rank or IV percentile. If the IV is higher and the skew is steep, you might have a great opportunity to sell premiums. Fourth, practice with the paper trades. Get comfortable spotting skew and adjusting your strikes before committing real capital. Okay guys, that's it for today. Volatility skew might seem like a small detail, but it can make or break your trades, especially if you are trading spreads or adjusting strike prices. If you found this video helpful, subscribe to Quant Academy and smash that like button. Got a question about the skew or want me to cover other advanced topics? Drop a comment, I'm always here to help. Until next time, trade smart, manage your risk, and keep learning. Thanks for watching.